Hello, everyone. Welcome to another edition of Your Wealth Matters. I am here today with my colleague, Paul Carter. Welcome, Paul. And today we're going to be reviewing some of the market events that we've seen happen over the last quarter, and it's been a pretty full quarter, so just bear with us. I hope this style of presentation will be easily digestible and that you'll enjoy it. So without further ado, Paul, why don't you start us off with some highlights? And the stock market at least is reaching some new highs. So what's the deal with that? Where are we at?
Yeah, so very good question, Maria. And I know investors are always dealing with something. There's never a quarter where nothing is happening in the markets. There's always something for people to be worried about. But these days, it seems like the list of worries is particularly long. That list includes geopolitical issues first and foremost. Obviously, what's happening between Iran and Israel is very concerning, not just to investors, but to everybody. Fortunately, after the U.S. carrying out strikes in Iran in June, we're now in a ceasefire situation. But a month into that ceasefire, it looks like that ceasefire is very tenuous at best. Iran's president Pezeshkian yesterday actually said that Iran has absolutely no intention of dropping their nuclear capabilities, and in fact seems to be bracing for war yet again with Israel. So we're getting questions about that from investors, and that is pretty concerning. You've got the tariff situation, which we've been talking about now, it seems like forever, but certainly the last few months. It's been an on-again, off-again situation between the U.S., Canada, and other countries. Here in Canada, we're about 1 week away from 35% tariffs being imposed if a trade deal isn't struck.
We hear that on the news every minute.
Every minute of every day. And by the time we finish this, I'm sure the news will have changed yet again, because it's an ongoing issue that does create a tremendous amount of uncertainty amongst not just investors, but companies. Companies do not know if they should invest in that next project that they've been talking about investing in. And so you're seeing investment dollars sort of dry up in capital spending, which has a knock-on effect to potential future corporate profits. So that is a big concern amongst the investment community. You've got fiscal policy. In the U.S. on July 4th, they just passed the One Big Beautiful Bill Act, which President Trump is hailing as a massive victory. But just this week, the Congressional Budget Office came out and said that this act is going to add $3.4 trillion to the U.S. debt over the next decade. So that's obviously very concerning in a number of different ways. And then here in Canada, Prime Minister Carney hasn't come out with the fall budget yet. That's, of course, coming up in the coming months, and we don't know exactly what that's going to say, but I think it's pretty fair to assume that we're going to be running some fairly significant deficits in the years ahead here in Canada. So all of that has investors concerned, because what does that mean for inflation? What does that mean for interest rates, et cetera? You've got the U.S. dollar weakening. This is something I don't think everybody fully understands, but the U.S. dollar in the first half of 2025 fell by over 10% relative to other currencies. That is the biggest first half of the year drop in the U.S. dollar since 1973. So
it's pretty significant.
It's very significant for a number of reasons I won't get into, but not the least of which is investors around the world are now starting to doubt whether the U.S. currency can continue to be the reserve currency for the global financial system. You've got stretched equity valuations, especially in the U.S. market. The S&P 500 is now trading at 23 times earnings, which is very high in a historical context. You have persistent inflation worries. You've got high bond yields, which is causing the carrying cost for corporations borrowing money to be higher than it has been in the past. You've got strains with the consumer right now in the U.S. as an example. The delinquency rate on consumer debt at U.S. banks has increased for 14 straight quarters. and is now close to or maybe at a 10-year high. So there's, long list of things that investors are worried about and that we are thinking about on a daily basis.
Right. So this seems a little counterintuitive with my question. Why is everything so high right now, right? Equity markets are really high, but there's a long list of issues. So why do investors in the markets not seem overly concerned?
Yeah, it's a really good question and something that is perplexing a lot of investors. Right now, the volatility level of the U.S. stock market, as measured by the CBOE VIX index, is at a level consistent with an economic environment that you would think nothing is going on. And in fact, we are pretty close to not an all-time low, but a low in volatility in the equity markets since before COVID in 2020. So there is a lot of complacency in the market right now. And as you mentioned, stock markets are hitting an all-time high just this week. Both the U.S. Stock market, as represented by the S&P 500 or the NASDAQ, as well as here in Canada, the TSX Composite Index, they're all hitting new all-time highs. So what's going on? Well, putting aside all those worries that I just mentioned, which are definitely important to think about, there's actually a lot of good going on right now. For one thing, on tariffs. Okay, so certainly here in Canada, we're worried about what's going to happen on August 1st. But the U.S. is actually coming up with some trade deals with different countries. The U.S. and U.K. Entered into a trade deal recently, just in the last few days. A trade deal was entered into with Japan.
Yeah, I saw that.
The EU is a possibility next. Not sure exactly how that's going to play out, of course, but there seems to be a lot of movement on the trade front. And all of that is quite positive because that is having everybody's anxieties kind of reduce a little bit as to how damaging these President Trump's new trade sort of policies are going to have on the markets. We do have, despite tariffs and despite inflation that is still a concern, we are dealing with a global disinflationary trend. Outside of the U.S., certainly, inflation, I wouldn't say is completely under control, but it is cooling much faster than I think a lot of investors were expecting. And that gives central banks in Europe and elsewhere room to ease. In fact, in the Eurozone, inflation has been at or below the 2% target rate for the last couple of months. Now, it's not a long period of time, but it's a start. And then probably most importantly, as it pertains to the equity markets, is just corporate earnings. The corporate earnings environment continues to be very strong. Today is July 24th, and we're just getting started in the second quarter earnings season. But so far this year in the U.S., or this quarter, I should say, about 85% of publicly traded companies are beating their the consensus estimates for both revenue and earnings per share. So that's very good. Analysts actually have earnings per share in the U.S. growing at about a 9% rate in 2025 and about 14% in 2026. Combined with that, corporate profits are pretty close to an all-time high right now. So a lot of the dynamics that really sort of dictate where stock prices should be at are looking very, very good. On top of that, consumer spending has been surprisingly resilient, despite the strains that consumers are experiencing, and despite the worries that everybody has about the global economy right now. Consumer spending continues to be, it's not amazing, but it's very strong in the U.S. And with the U.S. consumer representing 70% of the U.S. economy, as long as consumer spending stays strong, that should be good for corporate revenue and therefore corporate profits. And then on top of that, consumer confidence is actually rebounding. So certainly a couple of months ago at the beginning of this whole tariff issue, consumer and business confidence plummeted because nobody knew what was coming next.
But everybody's kind of taking a breath now.
They are taking a breath, and that's actually translating into some of the confidence numbers. Now, the confidence is also pretty high because the unemployment situation still is pretty good. It's not as great in Canada as it is in the U.S., but the U.S. unemployment rate is pretty close to an all-time low. So that, of course, is going to play through into consumer confidence numbers, and that in turn is influencing consumer spending. So there are still a lot of very positive things that investors can look at right now, and that do suggest that the highs in the equity markets is not necessarily irrational.
So we do hear some comments still that we might still enter recession this year. What do you think is the risk of that? You know, we've just talked about some of the strengths in the market. Do you feel like, okay, that's unlikely? Maybe it is more likely. Where's the disconnect between these high equity valuations and this concern still that we might have recession this year, that we're not growing as we should be?
Yeah, no, it's a really good question. I mean, the recession risk is not off the table. There is still a risk of recession. More so here in Canada than in the U.S., but even in the U.S., there are still some economists and other large investors that believe that we might be headed into a bit of a recession here. In fact, in the U.S., in the first quarter, technically the U.S. economy contracted. Now, that was just because there was this massive surge of imports into the U.S., as retailers and others were actually bringing in product into
trying to get
the US.
ahead of the tariff issues.
Exactly. Yeah. And the way that the GDP calculation is done, that is a net negative to GDP growth. So the US had a pretty big negative print for the first quarter. But that's going to reverse itself pretty significantly in the second quarter, which just ended. You're going to see a big rebound in GDP growth in Q2. And most investors and economists are expecting not terrific, but not bad economic and GDP growth in the U.S. for the remainder of this year and throughout 2026. So we don't believe you're going to see this massive economic boom in the U.S., like some would suggest, but we do think that the growth in the U.S. could be, moderate and quite positive for the next, call it 6 to 8 quarters. Now, in Canada, we are in a bit of a different situation. In Canada, we are feeling the effects of the tariff situation.
Our employment's not as good.
Our employment's not as good in Canada. It has stabilized a little bit recently, but it is at a much higher level than where it is in the U.S. Exporters exported a lot less goods the last few months into the U.S. Than is typically the case for obvious reasons. And all of that is translating into GDP growth that is not as good here as it is in the U.S. In fact, the Canadian Federation of Independent Business just this morning came out with their quarterly report where they said that right now we are in a recession. In the second quarter, they anticipate Canadian GDP growth to have been negative 0.8% and then to be negative 0.8% in the third quarter. We don't necessarily believe that that's the case, but whether or not we're in a recession right now, I think it's going to be more of a technical thing. Are we negative for 2 quarters in a row, or do we actually have a positive print in either the second or the third quarter? So technically we might be in one, but I do think that there's a lot of evidence that suggests that in the second half of this year, going into 2026, we're going to see some positive growth here in Canada. Once again, similar to the US, it's going to be modest, but it will still be positive, we believe. And so that should support continued corporate profits.
So what does this mean for stocks? I mean, obviously, we're just projecting, but...
Yeah, so the stock market is fairly different, depending on what country
you see
you're
the
looking
divergence,
at.
yeah.
You're seeing a pretty significant divergence. In the U.S., as an example, in our funds, our equity funds were underweight the U.S. equities relative to our benchmark. And that's just because the U.S. market is very highly valued right now. I mentioned earlier 23 times earnings. That gives you an earnings yield of about, I think it's 4.3%, which is just about the same as what you can get on a 10-year risk-free U.S. government bond. Usually equities do not trade at the same valuation as bonds. There is this thing called the equity risk premium where you want a little more. You want a little more, but nowadays there is no equity risk premium in the US. So looking at the US market as a whole, it is not looking like great value. Now, having said that, even in the US, we believe that there are opportunities. For instance, so far this year, the US stock market has been driven by growth and momentum stocks. Think Nvidia or Google or companies like that. The growth and momentum indices are up anywhere from 10 to 20% so far year to date in the US. Whereas value stocks, high quality stocks, especially those companies that pay good dividends.
The blue chips.
The blue chips are, up maybe 5-6%, and actually in Canadian dollar terms are negative because the US dollar has weakened so much. So
that's easy to forget.
It is easy to forget. And so when people are talking about the US market, they're often thinking about Apple, Tesla, Nvidia. They're forgetting that there's this whole other segment of the market where you can still find pretty good value. So we're a value manager at Capstone, and we do believe that there are opportunities to profit by investing in the US market. You just have to be a little bit more selective right now. And certainly in Canada and other countries, such as those in Europe, we believe there's a lot more value, and so we're a little bit overweight those geographies.
Right, so you have to be picky. You have to pick your price point and really make sure that you're not paying too much for what you're trying to invest in.
Exactly.
Yeah. Okay. So let's maybe transition a little bit. So we saw a post on LinkedIn that you did a little while ago, or more recently actually, regarding Nortel networks. So do you want to maybe talk a little bit about that? It's an interesting...
Yeah, sure. So this is, it's interesting. So 25 years ago this week, Nortel Networks hit its all-time high. It was $124.50. And the reason I remember that is because 25 years ago, I worked downtown Toronto, and Nortel Networks was the talk of the industry.
Right.
You could not have a client meeting or a meeting with an investment manager without talking about Nortel.
And clients wanting to talk about Nortel.
Exactly.
Everyone.
So 25 years ago, the internet was booming. It was the modern day gold rush. Nortel, which was the dominant supplier of networking gear, was the ultimate picks and shovels play to take advantage of all this capital spending that was happening related to the dot-com boom. At its peak, Nortel hit a market capitalization of $250 billion US. To put that in perspective, at the time, it was close to 37% of the TSE 300 index, which was the benchmark here in Canada at that time. So even investment it was massive. Yeah. And even investment managers that hated Nortel stock could not afford not to own it, because it would present a lot of career risk. If they were underweight a massive amount, this one hot stock, that if it kept going up, they were doomed to underperform the benchmark. So the reason I brought this up, on the 25 or close to the 25-year anniversary, was because I see a lot of parallels with what you're seeing right now with Nvidia. Now, I don't want to suggest that Nvidia is going to follow the same path that Nortel did subsequent to...
so we're not suggesting...
No.
that it's on the same track, but
simply
valuations,
in terms of the valuations, and just in terms of the comments that I get from clients, like, Nvidia is just at the beginning of this AI boom. How can you not be invested in Nvidia? The growth is just getting started. You want to get on the train now. I heard all those same things 25 years ago with Nortel. Again, to put things in perspective, Nortel peaked at $250 billion US. Nvidia is now 17 times that. It is $4.2 trillion US in market cap. That is bigger than every single publicly traded company in Canada combined. It is bigger than the GDP of Canada. It is bigger than the GDPs of Japan, of the UK.
So it's big, really big.
It's massive. Now, Nvidia is a fantastic company that is doing a lot of really good things, terrific leadership. It truly is at the forefront of this AI boom. But it is a really good reminder, certainly the Nortel experience is a good reminder, that trees don't always grow to the sky. In fact, they never grow to the sky. And just because Nvidia has been an absolute amazing stock to own does not mean that today it is the best opportunity for the next year, 5 or 10 years. And that investors really do need to think about diversification in their portfolios and think about diversifying into stocks that perhaps offer much better value than something that's at $4.2 trillion.
Excellent reminder. Thanks, Paul. Well, I think we're going to leave it there. Thank you so much. And hopefully you've enjoyed this version of Your Wealth Matters. And we will be tuning in to see you again soon. And if you have any questions or if you have any topics that you hope that we would cover in one of these sessions, please feel free to reach out to us. We would love to hear from you. For now, bye.
Thanks very much.